The webinar will begin in 1 minute. Welcome, everyone. Thanks for joining us for today's webinar, A Big Mistake with Self-Directed IRAs. The webinar will last approximately 15 to 20 minutes, and at the end, we will tell you how to receive supporting materials by email. We'll also tell you how you may email questions related to today's content to the presenter. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, life insurance background and his practical experience for today's webinar. And here he is.
Thank you, Jennifer. Jennifer, appreciate the introduction. Glad that all of you were able to join us today. We're going to get into, in just a minute, the content, A Big Mistake with a Self-Directed IRA, which I think is of interest for all of us who work in anything related to financial services, because we end up getting asked about it by our customers. But before we get into it too deeply, let's go ahead and decide on what it is that we're going to cover next month. Next month's free webinar, you have 3 choices. Using the income tax return to better serve your clients. Second choice is free online resources to use in your business. And the third choice is what most clients really want to know about estate planning. Let's go ahead and open the poll and see what it is that you want to visit about next month. Go ahead, we're opening the poll. Let's go ahead and vote. We'll give you a few more seconds before we close the poll. All right, let's go ahead and close the poll. Next month, we will talk about using the income tax return to better serve clients. Thank you for voting. Thank you for participating in our webinar series. As a reminder, these webinars are free for everyone. They are held the first Wednesday of every month. The next one will be Wednesday, July 6th, and they're held at 11 a.m. Central. So if for whatever reason you feel like you know of another financial professional who could benefit from being part of the webinar, feel welcome to invite them. Feel welcome to get word to us. We'll tell you how to contact us later, and we'll be glad to put them on the regular invitation list. So let's go ahead and get started. Let's talk about a big mistake that a couple made with a self-directed IRA. And before we get too deeply into that part of it, let's talk a little bit about individual retirement accounts. And this is a big duh moment. For many, IRAs are an important part of their retirement planning. Saving money on a pre-tax basis in a traditional IRA is important for a lot of people. Most people are satisfied with using standard IRA custodians. When I say standard IRA custodians, what am I saying? I'm saying it's a life insurance company that sells an individual retirement annuity, and so you get whatever investments they offer in the individual retirement annuity. Others may go to a bank and they'll get whatever investments the bank offers, and some may go to a brokerage operation and get publicly traded securities as an option within the IRA. Those are not the kinds of things that I'm referring to when I talk about a self-directed IRA. When I talk about a self-directed IRA, I'm talking about somebody who wants even more control and someone who wants to use their IRA money to buy what I would term non-standard investments within the IRA chassis. Most custodians will not permit people to pick and choose their own investments. You have to either, in the most liberal of those, you get to choose publicly traded securities as part of your IRA basket. But if you want to get something that's a little more unusual, you got to seek out a self-directed IRA custodian. And that's the beauty of a self-directed IRA, is that the account owner gets to a lot of control over the investment decisions. Now, the control is not complete because the tax code prohibits certain kinds of investments. You're not allowed to engage in self-dealing investments, for example. And there are certain categories of investments that aren't available. Most regular IRA custodians will not permit that, but there are certain kinds of special self-directed IRA custodians that will allow the IRA owner almost complete flexibility on what to invest in, as long as the investments are within the scope of what's permitted inside of an IRA. And so you have to search kind of long and hard to find those self-directed IRA custodians. If you do, you can do the kind of transaction that the folks in this situation attempted to do. So let's go ahead. And before we get into the case, let's talk about the kinds of things that are prohibited as investments in an IRA. Life insurance is not permitted to be owned by an IRA. Collectibles that you might keep in your home, those are not allowed. An IRA is allowed to invest in gold and silver coins and bullion, but there's some limit to that, and we'll talk about that limit here in a second. S corporation shares can't be owned by an IRA. You've got to have a real person and pass through a result for an S corporation shares. And if you invest in prohibited investments, the amount that you invest in those wrong investments, that's considered to be a distribution from the IRA, and the amount that's invested is considered to be a taxable distribution, and potentially subject to penalty tax if the IRA owner is younger than age 59 and a half. And that's really what the case that we're going to talk about kind of turned on, and the mistake that this particular couple made had to do with too much control over the IRA assets. The case is McNulty versus Commissioner. You can see the tax court site on your screen. It was a case decided late last year. And the facts are somewhat straightforward. Andrew and Donna McNulty decided they were going to establish self-directed IRAs. They had done some reading online and found out that it is possible to have IRAs invest in gold and silver coins, and specifically American Eagle coins. That's what they were interested in investing in. And an IRA is permitted to purchase certain kinds of coins that are made of precious metals. So what the McNultys did, and the case specifically focused on Donna McNulty, Mrs. McNulty, they purchased services from Checkbook IRA LLC, which Self-Directed IRA custodian. Checkbook IRA LLC helped them set up a self-directed IRA, and they also helped the McNulty's form LLCs. Donna McNulty specifically put together an LLC. She subsequently transferred her IRA funds into the self-directed IRA. The self-directed IRA purchased membership interests in that LLC, and the LLC purchased American Eagle coins using the IRA funds. And Donna McNulty's IRA and its activities were the focus of this court case. So what happened in this court case that made it, such a mistake for these particular clients? Well, the details are these. Mrs. McNulty established the self-directed IRA. The IRA became the sole member of a company called Green Hill Holdings, LLC. Donna rolled over $400,000 to her self-directed IRA, and the self-directed IRA custodian bought more membership interests in Green Hill Holdings, LLC. So that's how the money got into Green Hill. Green Hill then used the money to buy the gold coins that are the subject of this court case. Here's the key detail that the court thought was a problem. The gold coins were sent to Donna as the manager of Green Hill Holdings, LLC, and Donna placed them in a safe. Now, the coins, when they arrived, were addressed to Donna mostly in her capacity as manager of Green Hill Holdings, LLC. But the court placed a lot of emphasis on the fact that Donna got the coins personally. She handled the coins personally, and she put them in her personal safe. So the IRS said, look, we get that you've got an LLC that is nominally the owner of these collectible coins, these gold coins. But you, Donna, received the coins at your home address, and you handled them and you physically put them in your safe, and that's where they are today. These coins are in your possession, Donna. Therefore, taken together, those acts are taxable distributions from the IRA to you, and they are taxable distributions equal to the coin's purchase price. Donna, on the other hand, said, no, that's not right. The coins are assets of the LLC, and Donna's physical receipt of them didn't constitute taxable distributions from her IRA. She pointed to language in the revenue code, which says this. So how does that sort out? Well, subsection B makes it clear that gold bullion must be in the physical possession of the IRA custodian. The IRA account owner can't hold it. There's no such explicit language for gold or silver collectible coins, but so that's what Donna really hung her hat on in trying to convince the court that there was no distribution of the coins to her, that it wasn't taxable, that Donna was holding the coins in her fiduciary capacity as a member of the IRA-owned LLC. At the end of the day, here's what the court decided. The court decided, first of all, that physical custody mattered, that Donna received a taxable distribution when she actually received possession of the coins. And that was the deciding factor. Even though there's a little bit of ambiguity in the statute over whether physical custody of the coins is a problem for Donna, the court decided that it was a problem. Donna taking the coins was too much control, and therefore they were going to be treated as a distribution from the IRA to her. Therefore, for 2015 and 2016, the McNultys underreported their taxable income by more than $268,000. And the court imposed the tax associated with that and also affirmed that the penalties for substantial understatements of income taxes for those years would also apply. Seems a little bit harsh, but that's what the tax court decided. The tax court decided that the McNultys should have known better, and therefore they were on the hook for the tax and the penalties. What do we take away from this? A lot of our clients are really tempted to be do-it-yourselfers. They have strong feelings that they are better with investment choices than institutions. And therefore, they are likely to ask you about self-directed IRAs, particularly those clients that just reject the idea that that institutional investments that's enough choice. Self-directed IRAs give taxpayers a lot of latitude with regard to choices of investments, but they're not without substantial drawbacks. There's a risk of self-dealing that less sophisticated clients are almost for sure going to run into if they do self-directed IRAs. That will disqualify their IRAs. There's a high risk of engaging in prohibited transactions, creating tax events, perhaps disqualifying IRAs. Self-directed IRAs, in my experience, have much higher administration costs than bundled IRA products. And the reason is that if the custodian doesn't make any money, has no chance of making money on the underlying investments, they have to charge for what they actually do rather than bundle in those expenses into other things. And so they're going to charge directly for administration, and those costs are higher. Our clients will generally put higher risk investments in self-directed IRAs, putting their potential retirement at risk. And so that makes it a bad choice for a lot of our clients. And it can result in less control over tax results if we're dealing with less standard investments. For example, if someone's got to take an RMD and they've got illiquid assets in a self-directed IRA, it's going to be a problem for them to come up with the money for the RMD. There may be a bad timing with regard to liquidation of IRA-owned investments. There may be missed RMDs, and so less control over tax results can be the results for our clients. Now, we as financial professionals need to be prepared to talk to our clients about self-directed IRAs, particularly those who are highly independent with regard to their investment choices. So I hope that the information that we talked about today during this short webinar are at least a little bit of help, so that you've got at least a working conversational knowledge that you can engage your client in conversation about whether a self-directed IRA might be the right fit for them. I'd like to thank you again for joining us today, and I'll turn the program back over to Jennifer to close us out. Jennifer?
Thanks, Linus, and thanks for joining us today. And don't forget to join us on July 6th for using the income tax return to better serve clients. As a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You can view this webinar and all of our past webinars on our YouTube channel, Advanced Underwriting Consultants. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 224-1291. Thanks again and best wishes for continued success.